Welcome to TDAM Talks. I'm Ingrid McIntosh, and if you've been saying what's going on with these markets, yes, the chaos is real. Volatility, news every day. But what if there's an opportunity here? What if there's a silver lining? Joining me today, Justin Flowerday and Monica Yeung to talk about what all of this means for Canada, for our economy, and specifically for the opportunities in our markets. Justin, Monica, welcome.
Thanks for having us on.
Great to be here.
Good times, huh?
Yeah, lots of fun.
Maybe we'll start with, we're recording this podcast in the middle of April. Today, the Bank of Canada paused on their rate decisions. We've had some other news, but maybe Justin, as head of equities here at TD Asset Management, can you paint a picture for the market landscape to kick us off?
Yeah, so you used the word chaos. I think that's appropriate. Challenging is another word. Yeah, it's been a challenging
It's
time.
adjective full.
Pardon me?
Adjective full.
Yes. No, we can use lots of adjectives to describe, but it's been tough for investors. Obviously, it's been tough for businesses who are dealing with change in the rules, and anytime you have a change in the rules that dictate the economic profit that a company is going to earn, it can create bad decisions. It can create delays, and so that's what we're going through right now. But I would say the Canadian markets in general have actually held in quite nicely. Like they're not tearing it up, but they're probably outperforming the U.S. on a year-to-date basis, and a couple sectors have held in quite nice. Gold is obviously up. I think it's a function of a few things. Number one is you have probably a new home that certain foreign investors are looking for, and so we've seen a bit of an inflow there. And look, Canada's a really stable society, stable economy, right? Solid financial institutions, world-class resource assets. So lots of reasons to come to Canada, and I think that's been one of the things. But look, it's been volatile and challenging and tough.
And there's no playbook, right?
There's no playbook.
Yeah.
But we're hanging in there.
As we go through this conversation, I'm going to dig a little bit deeper on things like the upcoming election and tariffs and so on. Maybe just as a starting point, because we are going to focus this discussion on the Canadian landscape. Maybe can you take a look at, what sectors are starting to look real appealing? Like who are the winners and the losers from a sector perspective when we look at Canada right now?
And maybe I'll take a stab at that. In terms of sectors that are interesting, you can think of ones that are perhaps less tariff impacted. And one of the great things about Canada is we do have a lot of these domestic champions in sectors like grocery, discount retailers, for example. Those are kind of inwardly focused, so don't rely a lot on exports, aren't as impacted by tariffs. And then they also have a defensive tilt. So if we do think or are concerned that the economy might be slowing down, well, typically people might eat out less, but they'll still shop for groceries. They might trade down in terms of going to a discount retailer instead. The other area that's performed quite well, and 10% of the TSX now, is gold. And it's really performed like that risk-off defensive asset that you would have expected. I think one thing that's interesting about Canadian gold companies right now versus times past is they have very healthy free cash flows, and on top of that, low debt. So cycles past, we would have seen their balance sheets much more levered up. That's not the case today. They're in much better positions than they were in times past. And then we've seen the commodity price really react as well to the geopolitical uncertainty, the market uncertainty.
That's the good news story. Are there sectors of the Canadian economy that are most exposed to the volatility and the chaos and the lack of sort of clarity that we have right now?
I could think of three, and they are sectors that we like medium term, longer term, but right now are going through a bit more uncertainty, turmoil, and they are a little bit more cyclically oriented. So the first being energy. So if you think global growth is slowing down, we've seen oil prices take a hit. WTI is right now at $60. These are great companies, great free cash flow, good balance sheets, but at the end of the day, the stocks will follow the commodity price. So that's energy producers in particular. The other two would be banks, again, a sector that we quite like because healthy balance sheets, good dividend payers as well, good dividend growers. But the story for 2025 was really one of leveling off of loan loss provisions. If, again, we're seeing tariffs prolong in terms of the duration, what will likely happen is that banks will start to take provisions onto their balance sheets. So that would be a headwind in terms of earnings growth going forward. And the last would be the Canadian rails. They're really right in the mix of all the trade wars, not directly impacted, but they facilitate trade flows. So if tariffs, an outcome of that is that trade slows down cross-border, the auto industry is obviously in the thick of all of that. That would probably be a headwind for the Canadian rails as well.
When we think about all of the trade and the tariff noise and the overall US-Canada relationship, which feels like it's fundamentally changed, right? The things that we've always held true for so long, suddenly not so much or we can't rely on. But when you think about what's happening, how do we think about the positive outcome from this? Like, what are the types of pressures that it's forcing Canadian companies or governments really to look at? And how do we think about what we might be doing differently that in the long run could be a positive?
Yeah, maybe I'll take a stab at that. This is obviously a really tough time, but if we look at 3, 4, 5 years, we have a window to make some changes in the face of what's looking like a little bit of protectionism in the U.S. This has opened a window for us, and we need to take advantage of it. And so, we've got obviously an election coming up, and we're going to have a leader who will have a new mandate to move forward with some changes, and these changes are going to have to be, I think, quite significant. We're going to need to see changes in policy in terms of tax. We're going to need to see investment in infrastructure. We're going to need to see cutting of red tape. We're going to need to see just a faster overall movement in terms of allowing foreign capital to come in and drive some of the productivity gains that this country has needed for a long, long time. And we have a window to achieve that.
Yeah,
And it's
silver lining. Yeah.
that's the silver lining.
Yeah.
Challenging times in the short term, but potential for long-term gains that can advance the productivity that this country has been lacking for so long.
I think it is a silver lining because it's a wake-up call for all of us. Like, when one could really argue perhaps we've been a little complacent, comfortable. I mean, the economy's been chugging along the last decade or so, and I think sometimes you have to face road bumps to really look inwards. Something as simple as energy, I think, in the face of tariffs or the threat of tariffs, it's really emerged how dependent we are in terms of exporting to one country. And that doesn't really lend to a resilient economy or a resilient sector, if you will.
Without predicting an outcome, we do have a federal election coming up in a little under 2 weeks from the time that we're recording this podcast. How might the threat of tariffs drive some of the policy changes that could benefit the Canadian market in the long run? Like, if you're an incoming leader, what would be those top things? And I think you've touched on this a little bit, Justin. What would be the top things that you'd be focused on? And then I'm going to ask you a follow-up question in terms of, as investors, what should we be watching for as the big policy movers? So,
Yeah, and look, I think the good news is that both leaders, both potential candidates, will come through with a pro-growth agenda and something that is going to move the Canadian economy forward in a positive way. They'll do it a little bit differently, though. I think if you look at Polyev, I think we're probably, tax cuts are going to be at the front of his agenda. Deregulation is going to be a big part of his platform. So some really positive things there. I think, Carney brings forward this kind of, global international presence where he's connected to a whole bunch of leaders around the world. And so we could see some policies that are garnered towards attracting foreign capital from someone like Carney. So, either way, I think decision making around projects gets shorter. I think red tape does get reduced under both. And so I'm quite excited to, move forward to that next chapter. And I think, Canada will be in a good place once we get through some of the short-term noise.
I know we're focused on Canada, but when we were prepping for this conversation, one of the things I'm really uniquely interested in, because it does play into asset allocators, with the noise in the US and the uncertainty. For a long time, the US has really enjoyed quite a risk premium around multiples, et cetera. But how is that changing? And when you look at relative valuation across asset classes and not asset classes, but really geographies, how's that shifting? And what does that mean for maybe Canada versus US from an asset allocator perspective?
I think the last few weeks, something that's been quite evident is that this market leadership that we've had for the last decade or so, which has been concentrated in US large cap tech primarily, had really kind of run quite far. It was very narrow. It was very concentrated. Last year, the theme was really this U.S. exceptionalism, if you will, and there was almost like nothing else to buy out there other than large cap U.S. And markets are mean reverting. You kind of can only go so far before you get checked back into place, and I think that's exactly what we saw. Every decade, if you look back in time, has its own market leadership. Rarely is it the case that leadership continues into the next decade. So you can look at the Nifty 50s in the 60s, energy in the 70s, Japan in the 80s, tech in the 90s. We had China and commodities in the 2000s, and most recently U.S. tech. And I think this was just kind of a wake-up call to say, hey, what else is out there? Finance 101 is to diversify your portfolio, right? And it's not to say that the U.S. is not still a great market. It is. It probably needed just a bit of correction. But I think it's prudent for any investor out there to be diversified across markets, whether it's the U.S., global, or Canada.
That's a great segue back to the next topic I want to cover, which is when we then come back to Canada, what are some of those things that are uniquely Canadian? What are those core advantages that we have that we would really want to shine a light on from an investing perspective?
Mhm. I mean, at top down, a couple things that make Canada unique and I think a very attractive market. One is that we're energy, food, water independent. So when you think about geopolitical risk, market uncertainty, to live in an economy where we're not dependent on other trade partners for our core necessities really makes us resilient, I think, through and through over a long period of time. We have low political risk. We live in a pretty stable political environment here. And then I think again, to point back to what I mentioned earlier, we have these really great kind of local champions in key sectors. So things like the rails or within consumer, the banks, for example, even utility
That's
companies.
my next question is we haven't talked about financials, which is a huge part of our market. From where we're sitting today and as a relative sector opportunity, how are you feeling about financials?
Mhm. Um, so we broadly in our funds have really favored the financials because um, the way that we invest, or at least the dividend funds that we invest in, we look for dividend growth. So they've had a great track record of growing their dividend through and through. We tend to see that stock prices follow their earnings. Cash and dividends is one measure of them growing their earnings. And I think the Canadian banks and financials, insurance companies as well, have been able to do that over long time horizons. Where they're trading now, Canadian banks, they would be kind of fair in their valuation. But again, acknowledging some of the uncertainties that we have, might be some short-term hiccups around loan loss provisions, tariffs. But over the long term, I think that dividends will be sustained. They have good cash flow to cover it, and that
And that also helps manage the volatility of that exposure in your portfolio. You've got that consistent dividend yield.
It's really interesting when you think about Canada. I mean, Monica mentioned earlier some of the cyclical nature of a lot of the parts of the economy and parts of the market. And we're talking about financials, but we can almost lump in some commodities in there as well, where, you know, if we're in an environment that is, let's say, higher inflation for longer, and we're not going to use the word stagflation, but, a higher inflationary environment, a lot of these sectors are actually poised to perform fairly well. And you think, okay, well, how do financials perform well in an inflationary environment, which could be low growth? And you worry about the PCLs, and you worry about credit being an issue. Canadian banks have done incredibly well with credit and adjudicating credit over the years, and so any kind of rise in credit, I think, will be manageable. But then there's this kind of inflationary hedge, as I mentioned, where the value of the loans and the value of the balance sheet goes up, and it goes up with inflation. So the revenues get adjusted for inflation. The same with commodity prices. There's an inflation hedge embedded in the commodity prices. So, cyclical, however, a bit of a counterintuitive inflationary hedge through a different lens.
It's a great way to think about it. We've been talking about, the sort of the break in the relationship with the U.S., which has been our number one trading partner. But then we look at globally what Canada has to bring to the rest of the world. Can you talk a little bit about the sectors, about our rare earth, our minerals, et cetera? And again, the purpose of this podcast, I'm hoping, is to leave investors with this great feeling about just the tremendous opportunities in Canada. So can we dig a little bit down in terms of who our next great trading partners will be and what we have to bring to the rest of the world?
Well, hot off the press, just before I got here, I did notice that we are selling a lot more oil to China, um, and I think in it's gone up to something like 37 million barrels in March, and I think that was the number, but I could be wrong. And it's because China's dependence on U.S. oil they've started to question it, and they've started to bring that down. So we now have a pipeline that goes to the West Coast that can be used to transport more oil, and it has been used since I think last May, to transport more oil to Asia. That'll only accelerate from here. What we could also see, along with a lot of the changes we talked about earlier, was acceleration in permits in terms of extracting more minerals, more rare earths, more projects that can unlock some of the value hidden in, the Canadian geography. And I think we're poised to do that.
I'm going to pivot back to the conversation about what else inside our country, right? So as you were coming in, we were talking about some announcements that were happening at the provincial level, the way the premiers are working together. Can you talk about what we might be able to unlock if we start to knock down some of those walls within our own house?
Yeah, so the interprovincial trade is the big one that obviously has a lot of focus right now from politicians as well as economists and the market. And there's been a whole bunch of, I think, different ways of trying to measure the, let's call it the tariff within Canada that gets placed on trading with your provincial partners. Some people, I think I've seen, 7.9%. I think there was one report that said it was in the teens. Anyways, there is friction between doing business with your neighbor. Ontario came out just before this call and announced that they are removing any interprovincial barriers, and we can talk about what that means, and there's a whole host of things. But they're the first province to come out and say they will do that, but they need other provinces to step up as well and go along. You can't just have one province. You need all the provinces to kind of act harmoniously to move this agenda forward. But I think if they get it right, this could be a big boost to growth and, again, productivity.
And getting out of our own way. The currency market, CAD, right? So there's been a lot of volatility around that. Outlook for that, both just a general outlook and then, are there sectors of the Canadian economy that really benefits us, the stronger CAD?
So yeah, maybe I'll just start really quickly. It's
Another
really
big rock, right?
it's really difficult to come out with a strong projection for where the currency is going right now. Obviously, it was really weak versus the U.S. dollar for several months. In the last couple weeks, it's gotten stronger. We need to understand the rules of the game. Once we understand the rules that are being placed on businesses and the economy, I think we'll have a better sense of, what is a natural currency level that makes sense for international trade and international investment. Until then, if I were to have a guess, I think we're range bound between 135 and 145, and right now I think we're in the probably lower end of that range,
Yep.
meaning the Canadian dollar is a little stronger. But until we have the rules of the game, it's going to be very difficult to make a fundamental call on the currency.
And I think, as you were talking about the rules of the game, I imagine going into my game cupboard at the cottage and pulling an old game out, and there is no rule book in there anymore, right? So you got to
That's right.
look it up online. It's like that's kind of where we are.
That's exactly where we are, and we'll take a step further. I mean, let's play Monopoly. No,
Oh, that's
we know that Monopoly, you pass go, you get $200. You can go to jail. I can't remember. I haven't played in a while, but there's a jail. Like it.
that certainly seems to be an option.
That seems to be an off right now, and I don't know if I want to own the railroads. I don't know if I want to own, Connecticut. I used to love Park Place. Do I want to own that anymore? I mean,
Do you want bougie real estate or do you want a utility?
That's right. And so, I think that's a great analogy, and it's not to say investing is a game, but it's just to say, look, this is really challenging to make informed decisions when We just need certainty. Once we have certainty, things will be better.
We're a research-based organization with a focus on quality and understanding fundamentals, and somebody's taken, a kaboom to that. But is it fair to say that, we started with big chaos, and then as each week goes on, we're starting to see the responsiveness to the market volatility. We're seeing the off-ramps that get put in place to decisions. Do you feel like, as we're sitting here in April, that the frequency wave is maybe going to get smaller and smaller going forward in terms of the volatility, or could we be back where we were 3 weeks ago?
I think it's so unpredictable where we sit right now. But what I do want to say is that for us on the research team, our analysts, our portfolio managers, we've been prepared for this. We've been thinking about it since the summer when it became very likely that Trump would be in office. We started having conversations around what are his key policies, what are the impact of tariffs. We looked at every single holding that we own, understanding the upside, the downside. And so while it may feel very unsettling where we are right now, like the thing that I'd want to remind everyone is that it's also a period of opportunity. So volatility, you can manage volatility, and that's been what we've been doing, bringing in risk in our portfolios where we can. But it's also an opportunity to pick up excellent, high-quality companies at prices that we haven't seen for many, many years now, and that's really where we're leaning in our portfolios today.
And I do think it's so important is, we invest in companies, we don't invest in the market, and the market price on any given day is just what it is, and it's not always a reflection of the fundamentals, and this will calm itself out. Obviously, we've been talking to advisors, to clients a lot lately, and there's this one question that came up, and we were asked if we could bring it to you. And the question is, we're calling it the magic pen scenario. So imagine that you had a magic pen and you could immediately create a policy or a law to make Canada more attractive for investments and businesses. What would that law be? What would you do?
Yeah, I know exactly what I do. I don't know what I name the law, but it would be around moving quicker. Let's call it the National Permitting Act. Okay, that's the name
Okay,
of the law.
NPA. We're going to call it NPA.
It's the NPA.
Okay.
And what it is it's a set of rules and guidelines around moving new projects and new permits quickly through the system. And really, it's a guarantee. And it's 12 months. It's 12 months. If we will give you an answer in 12 months, yes or a no. No, it's 6 months, actually.
Okay.
It's 6 months. We're going to say yes or no, and there's going to be a set of criteria, and we're going to move quickly, and it's called the National Permitting Act. It's the NPA.
I love it.
Come on,
I
you're not
love it.
going to come up with your own, Monica?
So for me, I think it would be a set of policies that makes it easy to start a business in Canada.
Lever the great minds, the great resources, the great natural benefits that we have
Yeah,
in our
and
back pocket.
like there's no silver bullet here, but I would say we have such excellent centers of excellence in our academic institutions. You can think of Geoffrey Hinton at the University of Toronto, or some of the great machine learning work out of the Université de Montréal. And there's no reason that research can't be commercialized in Canada, but we need the appropriate federal grants. We need fast permitting to start a new business. We need tax policy to incent risk-taking in our country. We need immigration to support the human capital necessary. Like, it's a whole bunch of different things, but building businesses, creating national champions, that's what really leads to economic growth, job creation, and at the end of the day, I think a better economy for all.
And what it's called is it's the NCA.
Oh.
The New Company Act.
New Company Act, yes, I
The
love it.
NCA and the NPA, you heard it here first from our podcast to our policymakers. I love that. Any last thoughts, for our listeners who are looking at their asset allocation, looking at their investments, because this is an undoubtedly positive tone conversation. We look at the Canadian market. Anything I've missed? Anything I haven't thought about?
No, just stay calm. Don't panic. Don't change the plan. The plan was made for a reason and with goals in sight. And this madness will pass.
So I want to leave this podcast with a parting note. Like, in every market twist lies an opportunity to be seized. So stay informed, stay resilient. As you said, stick to the plan, because calmer days are ahead. Thanks, all.